Well, good afternoon. Happy Friday, September 26th. Mark Milam here, your mortgage professional. Let's get right to it. So we have been enjoying the best mortgage rates of 2025 all the way up until this week. And this week, we've started to see rates tick back up just a little bit. No huge moves, but we're certainly off the best levels of the year and unfortunately starting to see interest rates deteriorate or go higher as we move throughout the balance of this week. Why is this happening? Well, first, let's actually look at it and then we'll talk about why it's happening. So this is just a chart that I've made to kind of highlight here the similarities between 2024 and 2025, and I'll blow this up just a little bit. So back in 2024, as we approached the end of summer, we were all anticipating a federal funds rate cut in the early days of September 2024. That indeed did come. Not only did it come, it came with a 0.5% jumbo-sized cut. Well, what happened after that? Well, the 10-year Treasury, which is largely what dictates mortgage interest rates, took off higher and dragged mortgage rates with it. Kind of counterintuitive. Mortgage rates actually improved in advance of the cut. Then the cut happened, and we saw mortgage rates do an about face and head right back up to the levels they had just departed. And we finished out the balance of 2024 no better than we were at the midway point back in June or maybe even April or May of 2024. So this was a short-lived window of really a nice aggressive rates. And some people took advantage of that and refinanced or bought, and some people waited for rates to go lower and wish they hadn't. Fast forward to 2025 and we see such a similar set of circumstances playing out. Mortgage rates moving lower in advance of a Fed rate cut. This time the Fed only cut a quarter of a point, not a half a point like they did this time last year. And then what has happened since then? Well, the 10-year started to tick back up and mortgage rates have started to tick back up accordingly. Now, we are nowhere near this level of rebound that we saw in 2024. We've only risen maybe 1/8 of a point in interest rate from the lows of 2025, but still going the wrong direction after a Fed rate cut. Why is that happening? Well, there's a couple of different factors at play here. The first one is something that we're going to call, and you've probably heard this saying before, buying the rumor and selling the news. In advance of the Fed rate cut, traders were buying the rumor, buying into the fact that the Fed was in fact going to cut the Fed funds rate on September 17th. That's exactly what they did, and traders positioned accordingly. But when you get there, and by the time the Fed actually does what they've been telling you that they're going to do, it's time to sell out of your positions. And we see a little bit of market rebound or market bounce back as traders reposition their portfolio. So that's one reason. The other reasons are the exact same reasons that we had this time last year. Number one, the labor market really isn't weak enough to tell us that we're headed into a recession. We got a little bit of fool's gold in the labor market when we saw high jobless claims right before the last Fed meeting. Turns out that was a result of some flooding in Texas and then some purported false unemployment claims that drove that number higher. Yesterday's jobless claims actually came in under expectations, a good bit under expectations, giving credence to the idea that the labor market really isn't that weak. And you might say, yeah, but job creation has been really low with the non-farm payroll report. But when immigration is virtually zero, you just don't need to create that many jobs. So this robust job creation that we saw back during the Biden administration, we really don't need that kind of job creation when the government's not growing and the immigration has been stopped the way that it has. So non-farm payroll growth really just doesn't need to be that high. So right now, labor still showing some resilience, not showing that we're headed into a recession. So no relief there for mortgage rates. And then there's inflation, right? So inflation, the Fed's dual mandate is to promote maximum employment, there's labor, and then to promote price stability, that's inflation. Well, the price stability they're looking for is 2% growth year over year on personal consumption expenditures. Well, we got personal consumption expenditures this morning. This is the most recent monthly report, and we're not at 2%, we're not at 2.5%, we're all the way up at 2.9%, 2.8% range, at least for core PCE, and that is just simply too high. So inflation has not been beaten. So that's not exactly what we want to hear if we want to see interest rates go lower. And so this is the analogy that I'll use is it's kind of like you broke up with your girlfriend or you broke up with your boyfriend because you just had so many problems, and now you were getting back together and there's all this euphoria leading up to that Fed meeting and you're going to reunite, and now that's passed and you're back to realizing, you know what, we still have the same old problems to solve. labor market that's resilient and could reignite inflation, and inflation that is simply too high for the Fed's target rate. And because of that, we're starting to see the 10-year Treasury inch back north, and it will drag mortgage rates along with it. That is the story for now. Interest rates still good, but we're off of the best levels of the year. So if you see headlines like this, they're 100% right. The Fed did cut the Fed funds rate, but long-term rates, including mortgages, actually moved higher on the news. And Fed Chair Powell now caught in a little bit of a difficult position that rising inflation and slow hiring pose a challenging situation for the Fed. And we see a lot of dissension within the ranks of the Fed, and that's not necessarily a bad thing. The voting members should have the ability to express their opinion. But right now, as we gaze out into the crystal ball, we know the next Fed meeting is October the 29th, right before Halloween. And currently, we have another 87% chance of a federal funds rate cut, a 0.25% rate cut. I would expect that 87% chance to start to decline over the next few weeks as we realize the labor market is still resilient, as we realize inflation is not back in the bottle yet. It's not going to surprise me at all to see that 87% turn into 75%, 65%, and it's going to be a puncher's chance by the time we reach the end of October. In the meantime, interest rates are still good. You can still avail yourself of a mortgage rate down in the 5s with paying a little bit of points. If I can be of any service to you over the weekend, don't hesitate to reach out. Mark.Milam at highlandmtg.com. Have a good weekend.